Okay, so today we are going to be covering some of the questions, some practice questions for the life insurance licensing exam. And we're going to, an important thing to do is I'm going to show you guys also at the end of the video how you can create a system for yourself to remember these answers. So the trick to passing this exam, everybody, is on the first try, is doing all the practice tests in whatever course it is that you use, okay? Do all the practice tests, and then at the end of the test, look at all the ones you got wrong and study the questions you got wrong, okay? Most courses have like 3 or 4 practice tests. If you go through and you study all the ones that you got wrong and you use little like jingles or rhymes or poems or whatever you got to use to memorize those answers, which I'm going to show you at the end how to do that, then that'll help you pass. So as I'm going through this, I encourage participation, and you can put in the chat what you think the answers are, and we'll go from there. So if you have any questions, please don't be shy. This is the purpose of this is for you guys to learn. So come off mute, participate. What type of buy-sell agreement involves a partnership? Is it a corporation plan, a stock redemption plan, an entity plan, or a cross-purchase plan? Anybody have a guess? I don't know this one, so I'm just going to guess D. Okay, cross-purchase plan. So I'm going to put a D. Oh, and then we got stock redemption plan. Well, we'll go here and see what the answer is after. What the heck? And I got to zoom in and out for each of these. Okay. Minimum standards of conduct have been implanted during the replacement process. Which of the following is not a reason for these standards? To provide accurate information about policies, to establish rules to protect the public, to eliminate misrepresentations, or to lower insurance rates. Which one do you guys think? Any guesses? Yep, D, correct. So a replacement is when someone has a life insurance policy, and then another agent, someone sold the life insurance policy, and then another agent comes in and says, no, you're going to cancel that one and get this one. So there are certain things you have to do to make sure that a replacement is ethical. The purpose of those standards of conduct is not to lower insurance rates. It's really just to protect the public, and that's what all those have to do with. Which of the following life insurance provisions means a transfer of all or portion of the policy owner's rights under an insurance contract? Policy change, assignment, policy year, or modifications? Anyone want to take a guess? Which of the following provisions means a transfer of all or a portion of the policy owner's rights? Someone said A, policy change. Anybody think it's something different? It's I'm pretty sure it's assignment. So an assignment is when you transfer the rights of a policy, right? So we can go, what is assignment in life insurance? When the rights of one person are transferred to another. So that's an assignment, okay? Like if you look at collateral assignment of a life insurance policy is when someone uses their life insurance as a collateral to get a loan, right? They're saying, hey, look, even if I die, you're going to get your money. So this is my collateral. That would be a partial assignment because when it's paid off, when the loan's paid off, they get it back. Like they get full rights over again. What term is defined as any transaction in which a new life policy or annuity is purchased to take place of the place of another in force? This is like, we're on this big thing here, replacement. Okay, I'm just going to answer that one. Replacement is when you have a new policy or annuity to take the place of another one. Okay, it's a replacement. Not conversion. Conversion is when you have a term policy and you convert it into a whole life. It's with the same company. Okay, Debbie. Debbie was insured under her employer's group plan until her job position was terminated. Debbie got axed. Debbie got fired. 86 Debbie. After her termination, she changed her coverage to an individual insurance plan with the same insurer. This action is known as which of the following? Is that conversion, absolute selection, experience rating, or special enrollment? What do you guys think? Debbie had a policy with her company. She got canned. And then what did she have to, what's that called when she kept the policy with the same company? Don't be scared to be wrong. All right, guys. I give everybody permission to make mistakes here. Okay. Hey, there we go. There we go. I'll wait till at least 2 people put it in the chat. Thank you for your participation, Candace. In Florida, annuities have a blank day free look period.
14 day.
Let's see. Yeah. Okay. How long is the annuity free look period in Florida?
14 days.
Wow. It says 21 online. Let me email that. We'll do 14 here, but I'm going to email them and do this here. I'm going to copy this.
It was 14 days. It probably changed.
Well, annuities, I think may be different. So I think that's where the thing, that's where it was. So.
Okay. Okay.
Let me just put this here. Let's see here, 21. In Florida, okay, cool. Well, we're going here next. Which of the following is most affected by Bob paying his life insurance, by his life policy? Which of the following is most affected by Bob paying his life policy premiums frequently? Anybody want to take a guess? iPhone is correct. It is the cost. Now, the reason why, anybody here ever pay their car insurance 6 months at a time? I know I do. If I pay my car insurance every month, it's like $300. If I pay it 6 months at a time, it ends up being like $200 a month or something like that. So I get it way cheaper by paying 6 months in advance at once. So the cost is affected because every time you make a payment, they have to charge you for the transaction fee and for someone in the back office to process that payment and everything else. So the frequency of payment, you can pay a policy monthly, you can pay it annually, you can pay it quarterly. An insurance contract has many parts. Which of the following is not an insurance contract part? Application, endorsement, rider, or certificate of authority? It would be D. It would be D. So a certificate of authority is an application is the application that you fill out to complete the insurance, right? Like, hey, I'm filling out my application. An endorsement is if you say you apply for like something and then something changes in the policy and you have to make modifications to it afterwards, then that's an endorsement. Okay. And so like an endorsement is like, hey, if I got approved for if we applied for a preferred plan and I got approved at a standard for the standard rate instead of the preferred rate, I'd have to do an endorsement to accept that. The rider is one of the riders on the policy. So it's like a feature, right, that you add to a policy. So like a disability waiver of premium rider means that if I am on disability or if I become disabled, then I don't have to keep making my payments. Certificate of authority is what life insurance companies get to allow them to sell insurance in a state, okay? An insurance company that is chartered in Vermont would be a blank company in Florida. Would it be a domestic, a large, a foreign, or an alien?
Domestic.
The alien.
It would be a foreign company, okay? So a, sorry, excuse you. Okay, so a domestic company is a company that's domiciled in Florida, chartered in Florida. A foreign company is a company that's in the United States but chartered outside of Florida, and an alien company is a company that's chartered outside of the United States. Okay. Statements made to injure a person financially in business are best described as which term? Discrimination, intimidation, defamation, or misrepresentation. What you guys think? Trudy with the first right answer. There you go. Good job. Our first answer is right. First answer on the board. So that is defamation. Which of the following are not considered for group coverage? Employees and employer and employees, individuals related by marriage, individuals under a contributory plan. I don't know this one, so you're gonna have to help me out. But you want to, okay, see? Individuals related by marriage. Okay. Oh yeah, you're right. I think so. We'll see. When does a deferred annuity pay a death benefit to the beneficiary? Only when the annuitant dies within 6 months of receiving payments. When the annuitant dies before receiving any annuity payments. Only to a tertiary beneficiary when both the annuitant and primary beneficiary have died. Anybody want to take a guess? Yeah, that's what I thought. I'm thinking it's B too. When the annuitant dies before receiving any annuity payments. So it's if the person who is paying into the annuity dies before they receive payments, or the annuitant, the person who's going to get it, then I believe it's a death benefit in that situation. Betty has an annuity that will pay her a guaranteed $3,500 per month at age 71 for the rest of her life. What kind of annuity does this describe? Anybody want to take a guess? I think it may be good guess our iPhone. I think it may be B. I don't know how old she is now. Right. So with this information, we can say fixed. We could, if she's going to start it right now, then it could be immediate fixed annuity. But if she's not 71, if she's going to turn 71 in a year, then it would be a deferred. So we'll just take that guess there. Because if an annuity payment starts more than a year after the annuity is created, then it's a deferred. What should not be used in an advertisement or illustration? Footnotes, material in a precise format, define complete information, or printed information in 14-point type that is accurate. Yeah, I think footnotes. If a business wants to make sure it will be able to cover losses due to the disability of a key employee, the business should get key person disability insurance. Disability income. That makes sense. What term relates to an agent that convinces an insured to cancel their present policy for one that is not suited for their needs? It's either D or B. Coercion is usually some sort of threat. D or A. So let's see, what is twisting in insurance? Inducing, okay, yeah, it's twisting. So twisting is when you get someone to change a policy to take another, that's with misrepresentations. Okay. What is the guarantee of the Fair Credit Reporting Act? Guarantees theft regarding any policy, guarantees applicants' rights to any information held about them by a reporting agency, guarantees to take criminal action against individuals that use representations on their application, guarantees any ambiguity in a contract. It is B. So the Fair Credit Reporting Act means that if you apply for a life insurance policy and the company says that, well, we're going to change your policy rating or we're declining you or whatever the reason is because of some information we got from another source, then that applicant has rights to that information. Okay. So it's like saying like someone can't just go saying stuff about you and have it be confidential with those reporting agencies. Okay. Amy and John will receive a set amount from their annuity until one dies. What type of an annuity did they buy? I think it may be joint life, but we'll see. Let's look at it here. What is a joint life annuity?
If it's like life insurance, then yeah, it'll be joint life.
Yeah, exactly. Yeah, it's joint. I'm pretty sure it's joint. Oh, yeah, okay. Well, iPhones, because you're on your phone, I think. Maybe, I don't know. William applied for an individual health policy after being diagnosed 2 months prior with cancer. I'm gonna do this here.
Probably decline.
Yeah. Okay. Yeah. Assume that's a life policy. They'd probably be declined. But we do have policies that take cancer patients. What type of annuity is purchased with a lump sum? Flexible premium, fixed premium, single premium, or suitable premium?
Is it single?
That's it. There you go. Good job. So single premium annuity, you put one payment in there. Anybody want to give me an example of what a single premium annuity would be?
Like if somebody retire and they get a lump sum from there, they can put it over into annuity.
Exactly. Yep. So if they retire, they get a lump sum from their retirement account. They can just transfer it over into an annuity. What will happen if an agent moves out of Florida? Their license will be terminated immediately. Nothing will happen. They'll pay a $5,000 fine. They'll be required to complete extra CE credits.
Terminated immediately.
Yep. saw that one the other day, I think. Cool. In relationship to an annuity, the term suitability refers to which of the following? Obtaining information
Really?
from an
Oh,
applicant.
sorry.
It's okay. Obtaining information from an applicant to determine whether an annuity product is appropriate. Delivering the policy summary to an applicant. Converting the annuity from fixed to separate. Professionally applying an insurer's underwriting guidelines. So suitability is A. Obtaining info to determine whether it's appropriate. Okay. For instance, sometimes with some annuities, you can get a fixed annuity. Say someone's about to retire. That example we used with the retirement. Someone's about to retire. We're not going to give them a variable annuity. Right? Unless they really, really, really insist on it. But that just doesn't make sense because it's like you don't want them to lose all their money in the stock market right when they retire. So fixed makes more sense there. Which of the following is most likely used for underwriting purposes and includes information on an applicant's character and personal habits? Agent report, investigative consumer report, medical federal bureau report, or the buyer's guide?
It's either like A or B. Is it agent report?
It's the investigative consumer report.
Oh, okay, cool.
Yep. So the agent report is a part on the application where you as an agent can write notes. For instance, like if
Oh, gotcha.
yeah, like if you're on a phone with a client and you're like, Betty, do you smoke? She's like, no. And then you hear her husband in the background 10 minutes later, like, Betty, pass me one of your cigarettes. I forgot to buy some. Right? And she's like, hold on, I got to give my husband one of my cigarettes. And then he gives it to her, but she told you she didn't smoke, but she has cigarettes. It's like in the report, you're like, she actually smokes. She had cigarettes. She gave one to her husband. Like they were her. You know what I mean? So that's
Gotcha,
like, yeah, that's where you put notes like that. Or like if they're on medications, hey, they take this medication for this, not this, because a lot of medications can have dual, like many different reasons why they're prescribed. And some of them are for really serious conditions and some of them aren't that big of a deal. Jason was convinced to switch from his policy for a policy that would be detrimental to him. What does this scenario describe?
Twisting.
Twisting is when you get someone to cancel one policy to get you another one by misrepresenting the policy. Carl allowed his permanent policy to lapse and didn't choose another option. Geez, Carl. Which of the following will the insurance company most likely implement? The premium reduction option, the reduced premium paid up option, the extended term option, or the cash option? Dante had the trigger finger there with the extended term
Extended
option.
term. Yeah.
I know that, so that's cool. I think that means that if a policy lapses, it uses the cash value to automatically purchase extended term insurance. So if you have a $50,000 whole life policy as an example, and you got, $5,000 of cash value in there, and the policy lapses, that company's going to take that. If that's the case, the company takes that $5,000 and purchases a $50,000 term policy for as long as the $5,000 will pay for it. Does that make sense? Anybody have any questions what I mean by that? Okie dokie. In regard to yeah, Dante, yeah. So what this means is, say I had a $50,000 whole life policy, okay? So it's a whole life policy with a $50,000 face amount, okay? So if I have a whole life policy, $50,000, and I die, my family gets $50,000, my beneficiary. With the extended term option, if this is the case, that when a policy lapses, the extended term option is chosen. I don't know if this is the right answer, but if it is, What this means is that if I have $5,000 in cash value and my policy lapses and I don't choose any other options, okay, it's saying that the company is going to default to the extended term option because I have 5,000 in cash value in my policy. So it's not like that just disappears. It's a non-forfeiture option. It's a non-forfeiture value, meaning it's a money that I don't just lose it if I lapse on my policy. Does everybody get that part of it? If you have cash value in a whole life policy and the policy lapses, then you don't lose it. Okay, you guys get that? Great. So you can either get the cash option, which is, hey, I'm just going to get the whole 5,000. But what they're saying is that if the Carl doesn't choose the option in Florida, a company may opt. This is saying, what's the company going to do if what's the default that the company does if Carl doesn't choose an option himself, right? Like what's automatically going to happen if he doesn't call the company or anything? This is saying extended term option. I don't know if this is the right answer, but if it is, what extended term option is, it'll use that 5,000 in cash value to purchase a $50,000 term policy. Remember, we had a $50,000 whole life. So it's going to use that 5,000 to buy a $50,000 term policy for however long the $5,000 will pay for it. Okay. So say that policy costs $500 a year, right? Then he'll have it for, well, that doesn't make sense. Say it costs, $5,000 a year for his $50,000 term policy. He'll have it for 10 years, right? And then it's gone. So it uses that money to buy a term policy. Does that make sense? Okay, cool. In regard to the waiver of premium provision, which of the following is false?
Is it the last one? Because don't they have to be totally disabled for their